Okay, guys, welcome back into a new session. Been sort of an interesting week this week, hasn't it, Sam?
So, absolutely. So, it's been a crazy time in markets, and happy to be here to give you guys our opinions.
Yep. So we thought we'll quickly sneak a podcast in this morning and talk about the overnight Fed and what that could mean moving forward for markets, whether it's going to calm things down, whether we're going to see a bit more volatility or not to come in the coming months.
Absolutely. Now, just before we get into it, I do quickly want to say that, it really helps us out if you could scroll down and subscribe. And secondly, we are a business. We spend most of our day talking to individual clients about their investments, about their positions, and we offer education as well. It's free to open an account. If you want to trade with us, have a chat with us, click the link in the description. If you want more information about our education, go down there as well.
Absolutely. Don't forget, leave a comment if you want. If you've got an opinion on anything we're saying, love to hear your opinion as well.
Yeah, absolutely. We love to give opinions and to hear them and gauge, which is right and wrong, because a market is made up of a diversity of opinions. That's how it works.
Exactly right. That causes a lot of this volatility as well.
Yep.
All right, so overnight we had a 0.75% increase in rates from the Fed. Some were expecting 1%, some were expecting 0.5%. I guess there's a very diverse view on how high and how quickly they're going to lift rates there. That takes the Fed rate down to about 1.5, 1.75, with also the view left on the table of another 0.75 potential rise in July.
Absolutely. So I think last week we had really strong CPI numbers from the US for the month of May, 8.6% growth, I want to say. But regardless, it was more than expected.
Yep.
Core CPI growth was a bit more than expected, coming in at 6% as well. And that high CPI growth, or consumer price growth, was, I think, what tipped them over the edge to do the 75 basis point rise.
Yep.
Because they'd all been saying 50 basis points for so long, and they got the justification to go a bit further.
Yeah, I guess markets were sending the message that perhaps 0.5% wasn't going to be enough to bring this inflation under control. What I find really interesting here, though, and I think the big conversation could be had around this, is that lifting interest rates isn't really going to solve the problem. And even Jay Powell admitted to that last night. And he pointed to the fact that energy is the main contributor to inflation at the moment. Obviously blaming the war in Ukraine for that. I think it's a bit more complicated than that, the energy crisis that we're seeing out there, given that we've come out of COVID so quickly. And crude was already at, $90 US a barrel before the Ukraine-Russia war even broke out. So there's more to it than that, I'd say. But yes, energy is the main contributor, I would say, to inflation at the moment, which is way outside of the Fed's mandate. Like they can't really do much about it, can they?
No, absolutely not. And I think there are fair arguments to suggest that oil supply might get even worse at higher interest rates. You got to keep in mind that most oil wells, they're not like mines. They can be brought online and taken offline relatively quickly. And as funding costs for oil producers go up, there's less incentive to bring more oil wells online or more oil rigs online. So it could even worsen the supply side issues that the oil sector has faced. Now, I just want to say, though, I'm a big believer that those supply side issues have somewhat been resolved. We've had nearly 2 months now of big drawdowns in US oil inventories, of big buildups, I should say, in US oil inventories. So they're basically producing more than they're demanding inside the US. There are some issues with moving it to Europe, transporting that to Europe. But we've seen, profit margins for the producers go up. We've seen profit margins for refiners go up, and we've seen profit margins for retailers go up. So the price issues that I think oil is facing is more profiteering and cartel-like behavior from...
The energy companies wouldn't do that, Sam, would they? They wouldn't do that to us, would they?
From everyone along the energy chain, as opposed to a true shortfall. And I just want to say I think it's particularly bad here in Australia for petrol, because our federal government has spent, and indeed some state governments, have spent hundreds of millions of dollars subsidising oil refiners here in Australia. There's only a couple. And now that refining margins are blowing out, not giving any of it back to Australian taxpayers.
No.
They're happy to charge an arm and a leg when the times are good, and they're the biggest, socialists when the times are bad. So,
well, it's shareholders number one, isn't it? And then everyone else after that. So.
Yeah, well, yeah, a distant second.
Definitely. So, as we know, it's a complicated situation, isn't it? But at the top of all of this, to me, is obviously energy prices. So keep an eye on the crude price. That's the driver of inflation at the moment. Everything else should continue to slowly ease if we're seeing a lift in interest rates. So the dot plot from the Fed suggesting 3.4% by the end of the year. I've had a lot of people asking me the question of why central banks lifting rates so quickly, considering that households are being squeezed by inflation, cost of living's going up. It's already hard enough out there to then have to come up with extra money to pay interest rates. So do you want to cover that one?
I do, yeah. My personal opinion is that the quicker and higher they go, the quicker the inflation issue is resolved, the quicker demand drops off a cliff for oil, and prices come back down, essentially the quicker they can reverse course on interest rates or stabilize interest rates. And I also believe the lower the terminal rate will be.
Yep.
So if they ratchet up now and they get things under control, they'll stop a lot earlier, and they might not have to go as far as if it's a much longer drawn-out process.
Or for as long.
Now, there will obviously be negative economic measurables from that.
Yep.
Fair chance of a recession. I still think there's a high likelihood of recession. US bond markets are suggesting there's a high likelihood of recession.
In particular in the US, I think they'll find a recession quicker than what we will.
Yep. But markets have proven over the last decade or more that, at least in the short term, negative economic measurables aren't that negative for the market.
I think this time around it's going to depend on a few things, right? So I think the initial reactions might be a bit negative, right? So if we see really weak US economic data and the Fed is still lifting rates at that point of time, I think you're going to have that pocket where the market's going to get quite volatile. But ultimately, I think you'll end up being correct and the bulls will come back in at the point where the Fed shifts their view and starts going, okay, we're going to stop lifting rates and see what happens from here.
Yep.
At that point, when they come even a little bit neutral or a little bit dovish, I think then the expectation is they'll start stimulating again in a year's time or in 6 months' time or whatever, once economic data gets bad. But we've got to get to that point first, I feel, where over the next few months, let's just say we're coming into July, we've still got this expectation of a 0.75% rate rise, and we see weak economic data. What's that going to do to the markets?
Absolutely. And you may have noticed the symbolism as well. Tim a little bit more bearish, myself a little bit more bullish. You make a very good point. Obviously, no one wants sort of a stagflation type situation, but in my opinion, markets are forward-looking beasts, and the quicker and heavier they lift interest rates now, the sooner that future stimulus comes in, the sooner that they reverse course. And I think that's what the market liked overnight. Not 100% certain, because they were strongly higher and came right back off their highs. And that's even despite the fact they've been absolutely hammered down over the past month.
Huge, 10% move in 4 days, guys. That was pretty big, wasn't it, coming into this Fed announcement? So, definitely oversold markets at the moment. I guess my other take on what's happening with the central banks right now is that bond markets are already pricing higher rates. So if you're a company, if you're an individual wanting to fix your loan for 3 years, you're already paying that higher rate, even without the variable rates going up or the Fed rate or RBA rate going up. So I guess the damage is kind of already been done with the bond market a little bit as well, other than people that are on a variable rate. So lifting rates to meet the bond market right now, to me, seems smart. Right? Why wouldn't you put ammunition back in that barrel? Because if a stagflation event happens and the US does go for a recession and it's out of everyone's control, you might as well be at a 3% Fed rate so that way you can drop it back down again.
Yep.
You've got some ammunition in the barrel. Why wouldn't you, right? Get it there as quick as possible. The quicker you get it there, and I think I agree with you here, Sam, is lift it as quick as you can now. Just get it done, get it out of the way. Don't drag this out. The longer you drag this out, the longer we're going to have higher rates, the bigger the damage is going to happen. Whereas if you get it out of the way and we drop rates again in a year's time, well, they're saying there's a lot of savings in the system, aren't they?
Yep.
Right? Household savings are at a huge high after COVID stimulus and the rest of it. The economy could probably stomach it for a year, right? Higher rates. But if you got higher rates for 3 years, that's really going to hurt.
Yep, absolutely. And I think you're spot on there. The federal government and to a lesser degree the central banks gave us all this money. We stored it away, and now it's time to give a lot of it back.
They give us and then they take us away.
Yeah. They want that money back in the system and flowing around, as opposed to just being sat on and unproductive. So I think that's what we will see. A bit of money flowing back through higher interest payments.
So is this the true return to value, Sam? Now we've got interest rates back at a normalised rate?
I think so. I think we've been saying it for a long time. We're value-based investors, so really this is our sort of golden period. The more speculative stuff, your pipe dream stuff, the stuff that relies on cash flows 5 and 10 years out, suddenly those cash flows are a lot cheaper in today's money. You're discounting them at a much higher rate, so $1 million in 10 years' time is worth a lot less than $1 million now, whereas at 0% interest rates, it's practically the same $1 million now. So all those speculative stuff that rely on those forward outlooks are all a lot less valuable. Meanwhile, you've got these companies making fantastic returns in current day's money. Well, that's a lot more desirable because people are now seeking returns that exceed those interest rates. So your high dividend stocks, your low earnings multiple stocks, I think this is a style of investing that is a lot less speculative, a lot more predictable, and tends to perform very well over the long term, and it's really what I sort of favour.
I actually look forward to what's to come from here because I think people are going to be a lot smarter with their money in business. So if you've got to pay for that money, if you're going to pay interest a lot more than what we were before, then you're going to be more productive with that money. You're not going to just throw it around and just borrow a bunch of money, throw it at marketing and hope for the best. Now you've got to spend the money wisely, build a product that actually has value, build a product that people want or need, and get out there and actually grow a profitable business, not just keep borrowing money and keep raising capital to keep a business alive and hope in 10 years' time you're going to break a profit.
Absolutely. And I think that's a very, very good point. I think more modern research has suggested it, and I think it'll become more accepted in future, that over a longer term period, higher interest rates actually lead to better economic growth, better economic measurables for every reason that you just said. Those businesses now have to achieve a return above their borrowing costs. And as a result, struggling businesses will fail, and that'll be bad. But in the longer term, that capital will be redeployed towards more productive, more profitable, and ultimately, that'll achieve more growth in the economy.
So I know how I'm going to be handling this moving forward, guys. I'll be investing in value stocks, trading the growth stocks, guys. So short-term trading on the growth stocks because they're going to be volatile as hell through this next year or so. Value is where you want to be invested, something that actually is going to make a profit and that profit's either going to grow or hold steady with a good dividend over the next few years.
Absolutely. And we're very lucky in Australia. We've got a predominantly value-based market.
Yes, correct.
So there's plenty of great stocks out there. We're obviously a big favour, or have been, in favour of commodities producers for a very, very long time. That's not changing anytime soon. And there's a lot of stuff outside the commodity space that looks attractive now as well.
Yeah, look, if the future potential recession sends commodities a little bit lower, that's just going to be a buying opportunity for me. So,
Yep, absolutely. So, You've got historically high prices, but these stocks aren't priced for those historically high prices. They're priced for those commodity prices coming back a bit. So even if they do come back a bit, there's some fantastic buys out there.
Absolutely. All right, well, that's all I really wanted to talk about today. You got anything else to
No,
bring to the table?
I think we sort of touched on the most important things for people, especially coming out of last night's decision.
Yep.
There's going to be more rate rises next month from both our RBA and the Fed. If you have any questions about that, mention them in the comments or give us a phone call. But I think that's it.
I'll just leave it at, I'm not sure where the bottom of this market is, guys. It could be here, could be another 10% lower. Technicals are still suggesting on the S&P 500 maybe about 3,500 for a good target, but I'll call it when I see it, guys. I never try and pick a bottom. I always look for the right technical signals, the right shift in sentiment, and then we go in a bit harder. So.
Absolutely. And my personal opinion is we might not yet be at the bottom, but in general, I think there's a lot of stuff that if you buy around these prices over a long-term period, you'll do extremely well.
Long term, yeah, agree with that. Cool. All right, leave it there. Thanks for listening in, everyone.
Thank you very much, guys. See you in the next one.
Bye for now.